A pleasant day, everyone. We will going to discuss tax rate, capital gains tax rates. And now let's proceed to our objectives. The objectives in this discussion: understanding how capital gains taxes impact your investment returns can help you make informed decisions about buying, selling, or holding assets, ultimately maximizing your after-tax profits. Let's discuss what is capital gains tax rates. Is a tax imposed on the gains presumed to have been realized by the seller from the sale, exchange, or other disposition of capital assets located in the Philippines, including pacto diretro sales and other forms of conditional sale. On the other hand, capital gains taxes are imposed on the profit earned from selling an asset like stocks, real estate, or a business at a higher price than what you originally paid. The capital gain is the difference between the sale price and the purchase price. If you own the asset for over a year before selling, it's termed a long-term capital gain and usually has a lower tax rate compared to a short-term capital gain, which applies to assets held for a year or less and is taxed at the same rate as your regular income. Now, let's discuss domestic corporations, and we do have here the transaction, rate, and tax base. So first transaction, sale of shares of stock of a domestic corporation not listed and not traded through a local exchange, held as a capital asset. So here's the tax rate of a 15%, and the tax base on it is on the net capital gain. And the second transaction, sale of land and or building in the Philippines held as capital asset. Basically, the tax rate is 6% and the tax base is on the gross selling price or the current fair market value at the time of sale, whichever is higher. Now, let's discuss foreign corporations, resident or non-resident, and we do have here transaction, rate, and tax base. Transaction, sales of stock of a domestic corporation not listed and not traded through a local stock exchange, held as a capital asset. So basically, the rate is 15% and tax base is on net capital gain. So basically, the capital gains tax rate has been increased to a flat rate of 15% regardless of the amount of the net capital gains.
Good day everyone, this is Valentin. So now let's move to final withholding tax rate under the domestic corporation. So domestic corporation, it is created or organized under the Philippine law such as the telecommunication, banking, real estates, and small and medium enterprises. So now let's take a look at this table. So this is the domestic corporation income with their final withholding tax rate. So the first one is interest from any currency bank deposit. So the example of the large banking industry here in the Philippines is the BDO, Metro Bank, Rizal Commercial Banking Corporation, and Land Bank of the Philippines, and many more. So yield or other monetary benefit from deposits, substitutes, and trust funds, and similar arrangement and royalties are subjected to final withholding tax rate of 20%. Next is interest from depository banks under the foreign currency deposit system of a local banks or branch of foreign bank authorized by Bangko Sentral ng Pilipinas is subjected to final withholding tax rate of 15%. Next is cash and or property dividend that are received by a resident foreign corporation from a domestic corporation shall not be subjected to final withholding tax. Lastly, interest income from long-term deposit or investment is subjected to a final withholding tax rate of 20% and regular corporate income tax of 30%. Now let's move to our next slide. Let's discuss the exemption of foreign source dividends received by domestic corporation. In general, foreign source dividends are subjected to RCIT or regular corporate income. However, it will be exempted if all of these three following condition concur. So the first one is such dividends actually received or remitted into the Philippines are reinvested in the business operation of the domestic corporation in the Philippines within the next taxable year from the time the foreign source dividends were received. So it means that it will be exempted if the received foreign source dividend is not spent. Instead, they reinvest it and use as a capital in domestic corporation in the Philippines. The next one is it will be exempted if the received foreign source dividends are used for utilization. So the funds are being used for the working capital requirements in the corporation, capital expenditures, where you purchase an equipment that can be used for more than 1 year, and it used for the payment for the dividends. Next is investment in domestic subsidiaries, where you invest into the related parties and infrastructure projects such as buildings. Lastly, the domestic corporation holds directly at least 20% of the outstanding shares of the foreign corporation, which means it will be exempted if you own a percentage of at least 20% in the foreign corporation and has held the shareholding for a minimum of 2 years at the time of dividend distribution. Now let's discuss the long-term deposits. So always remember guys that the individual who earn an interest income from long-term deposit or investments are exempted to tax. It will only be subjected to tax before the termination of an individual. But if the interest income earned by corporation from long-term deposit, it will be subjected to these two following tax. The first one is 20% final withholding tax or FWT. This is for interest income from long-term deposits issued by banks or investment certificates considered as deposit substitutes. So some example of this is purchasing of bonds and stocks of real estate property. The next one is 30% regular corporate income tax or RCIT. This is for interest income from long-term deposits not issued by banks or investment certificates and not considered as deposit substitutes. So some example of this is interest earned from bonds and income earned by business. Now let's move to resident foreign corporation. So the rate applicable to resident corporations is the same as domestic corporations, except for interest from depository banks under the foreign currency deposit system, where a particular kind of time deposit that banks offer to clients who want to store foreign money for future use or protect themselves from currency fluctuation. So which is subject still to the old rate of 7.5% since the train did not amend the provisions about RFCs. However, this has already been amended to 15% under the Corporate Recovery and Tax Incentives for Enterprise Law. Now let's move to the table of non-resident foreign corporation with their final withholding tax rate. So the first one is all sources of income such as interest, dividends, rents, royalties, salaries, premiums, annuities, emoluments, or other fixed or determinable annual, periodic or casual gains, profits, and income and capital gains, except capital gains subject to capital gains tax, and those provided below are subjected to final withholding tax rate of 25%. Next is interest on foreign loans are subjected to final withholding tax rate of 20%. Next is intercorporate dividends provided that the country where the company is domiciled provides for 15% credit on Philippine taxes being paid is subjected to final withholding tax rate of 15%. Interest from depository banks under the foreign currency deposit system shall not be subjected to final withholding tax under non-resident foreign corporation.
For the income status rules, we have 7 types. First is the interest income. Its status of taxation is in the debtor's residence, meaning the interest income will be taxable based on the debtor's place or location. For example, the creditor is living in America, but the debtor is living in the Philippines, so the interest income is collected within the Philippines and it will be taxable within the Philippines. Second is the royalties. The status of taxation is where the intangible is deployed. Example for the royalties is the copyright of a songwriter, meaning the status of taxation is where the song is being used. Third is the rent income. The status of taxation is the location of the property. For example, I am living in America but I have a rental property in the Philippines. So, the income will be collected in the Philippines and it will be taxed in the Philippines. Fourth is the service income. The situs of taxation is the place where the service is rendered. For example, I am born in America but I worked in the Philippines. So, I earned my income in the Philippines, so it will be taxable in the Philippines. Fifth is the gain on sale of personal property. The situs of taxation is if domestic security is presumed earned within the Philippines and if other personal property is placed where the property is sold, meaning that it will be taxable to where the personal property is sold. Sixth is the gain on sale of real property. The situs of taxation is the place where the property is located. For example, I have a land in the Philippines. So that it will be taxable in the Philippines because the land is located in the Philippines. The last is the income from merchandising business. It is where the property is sold, meaning it will be taxable to where the property is sold.
Interest income from deposits in foreign bank. This refers to the earnings an individual or entity receives from keeping their money in a bank located in a different country. So that's interest income from deposits in a foreign bank. So the 300,000 example is the interest income from deposit in a foreign bank. For interest income from domestic bonds, it refers to the earnings received by an individual or entity from interest payments made on bonds issued within the same country. So the example of 50,000 is from interest from domestic bonds. Royalties from books published in the Philippines. It represents payments made to authors, writers, or publishers for the use or reproduction of their work. For taxpayers in the Philippines, these royalties are subject to specific tax rules and regulations. So the example of 100,000 is from royalties from books published in the Philippines. Rent income from properties abroad or the lease contracts were executed in the Philippines is subject to taxation according to Philippines tax laws. So the taxable income of this is rent income earned from properties located outside the Philippines is considered part of the taxpayer's global income. This income must be reported in the Philippines and is subject to Philippine income tax laws. For residents versus non-residents. For residents, Philippine residents are taxed on their worldwide income. This means that all income, including rent from properties abroad, must be cleared and taxed in the Philippines. For non-resident, are typically only taxed on income derived from sources within the Philippines. However, if they have income arising from lease contracts executed in the Philippines, further legal advice may be required to determine specific obligation. So the example of 150,000 is from rent income from properties abroad or the lease contracts were executed in the Philippines. Professional fees for services rendered in the Philippines to non-resident clients are paid in US dollars converted to Philippine peso. In taxable income, the professional fees earned for services rendered in the Philippines are considered taxable income regardless of the client's residency status or currency in which the payment is made. So the example of 400,000 is from Professional fees or services rendered in the Philippines to non-resident client are paid in US dollars converted to Philippine peso. So, if the taxpayers are resident, citizen, or domestic corporation, the taxpayer is taxable in his or her its world income. If not, then the taxable only his or her its income within. For interest income foreign deposits is the resident, citizen, and domestic corporation is taxed on worldwide income, including foreign deposit interest. To non-resident citizens and foreign corporation is taxed only on a Philippine source income, excluding foreign deposit interest. To ensure accurate reporting and compliance with Philippine tax laws, consulting with a tax professional or accountant familiar with international income and the relevant provisions is advisable. This will help optimize tax obligations and ensure adherence to all relevant regulations. So the interest income on foreign deposits without the Philippines is 300,000 and the world income is 300,000 also. For interest income from domestic bonds, is resident citizens and domestic corporations is taxed on worldwide income including interest from domestic bonds. To non-resident citizens and foreign corporation is taxed only on Philippine sourced income, including interest from domestic bonds. Ensuring proper tax compliance involves understanding these tax obligations and, when necessary, seeking advice from a tax professional to navigate any complexities related to international and domestic tax laws. That's why it belongs within the Philippines is 50,000 and the world income is 50,000 also from interest income from domestic bonds. For royalties from books in the Philippines is for resident citizens and domestic corporations is taxed on worldwide income, including royalties from books, regardless of where the books are published. For non-resident citizens and foreign corporations is taxed only on Philippine source income, including royalties from books published in the Philippines. To ensure proper tax compliance involves understanding these tax obligations and keeping through records. Consulting with a tax professional can help navigate any complexities and optimize tax obligations. That's why it belongs. So within the Philippines is 100,000. The world income is 100,000. Also is the royalties from books in the Philippines. For rent income on foreign properties is resident citizens and domestic corporations is taxed on world income, including rent income from foreign properties. For non-resident citizens and foreign corporations, is taxed only on Philippine source income, including rent income from foreign properties. To ensure accurate reporting and compliance with Philippine tax laws, it is advisable to consult with tax professional or accountant familiar with both local and international tax laws. This can help optimize tax obligations and ensure adherence to all relevant regulations. That's why rent income on foreign properties are belongs to without the Philippines and the world income are both 150,000. And the last, professional fees. Resident citizens and domestic corporations is taxed on worldwide income, including professional fees earned both domestically and internationally. For non-resident citizens and foreign corporations, is tax only on Philippine-sourced income, including professional fees for services rendered within the Philippines. To ensure this accurate reporting and compliance with Philippine tax laws, consulting with a tax professional or accountant familiar with both local and international tax regulations is advisable. This will help optimize tax obligations and ensure adherence to all relevant rules. That's why the professional fees are belong to within the Philippines and world income are both 400,000. So the total within the Philippines is 550,000 and without the Philippines is 450,000 and the world income is 1 million.
Now let's go to example 2. Income citus rules to manufacturing businesses. Let's try to answer this together. First, the gain of sales of domestic stocks. The production will be within the Philippines, so the distribution will be in the Philippines also. Second, gain on sales of foreign bonds. So, the production will be abroad and also the distribution will be abroad. So, it is without the Philippines. Third is the gain on sales of a commercial lot in Manila. Since Manila is part of the Philippines, so the production will be within the Philippines and also the distribution will be on the Philippines. Fourth is the gain on sale of car in USA. So the production is in the Philippines but the distribution is in USA. Gain on sales of machineries in Bulacan. So the production will be in Bulacan, so the distribution will be in Bulacan also. Interest income on foreign bonds. So the production will be in the Philippines, but the distribution will be abroad. Dividends on domestic stocks. It will be produced in the Philippines and also it will be distributed in the Philippines. Goods purchased and sold within the Philippines. Since the production is in the Philippines, the distribution will also be within the Philippines. Goods purchased and sold abroad. Since the production is in abroad, so it will also be distributed abroad. So it is without the Philippines. Goods purchased within the Philippines and sold abroad. Meaning, the production will be in the Philippines but it will be distributed abroad or without the Philippines. Last, goods purchased abroad and sold within the Philippines. Meaning, the production will be abroad or without the Philippines but the distribution will be within the Philippines. Mapapel Corporation manufactures paper products and sells them through its branch. Mapapel bills its branch at established market prices. Accordingly, Mapapel reported the following gross income. For the home office or the main branch, the sales is 4 million and it will be less by the cost of goods sold, which is 2,400,000. And the gross income is 1,600,000, which came from 4 million minus 2,400,000. And for the branch, the sale is 2 million and it will be less by the cost of goods sold, which is 1,200,000 equals 800,000. So for the total sales is 600 million and the total of the cost of goods sold is 3,600,000. So 6 million will be less by 3,600,000 and the total gross income is 2,400,000. So, what is the situs of the income earned by Mapapel Corporation? We shall assume different scenarios. Reminder, both production and distribution are conducted by Mapapel Corporation. The branch is not a separate taxable entity, but it is an integral part of Mapapel Corporation. Integral meaning it is part of the whole. Hence, the branch income is taxable to Mapapel. For the first scenario, their home office is in the Philippines. Their branch is in the Philippines also. So, it will be taxable within the Philippines. So, their gross income will be 2,400,000. Second scenario, if their home office is located in abroad and also the branch is established abroad, it will be taxable without the Philippines. So meaning their gross income is still 2,400,000. For the third scenario, if the home office is in the Philippines and the branch is located abroad, so the gross income within the Philippines is 1,600,000 because it is in the Philippines, while the gross income of the branch is 800,000, which is located abroad. So, as you can see, it is divided. It is because it is not on the same country and is taxable separately. For the fourth scenario, if the home office is located in abroad, for example, in America, and the branch is located in the Philippines, the gross income within the Philippines will be 800,000 because the branch is in the Philippines and that gross income will be the only income which is taxable within the Philippines. And also, as you can see, the 1,600,000, which is the gross income of the home office, is in the column without the Philippines because it will be taxable outside the country. It will not be considered taxable in the Philippines. For the conclusion, scenario 1, the status of it is the domestic corporation because the home office is in the Philippines and also the branch is in the Philippines. For the second scenario, the status of it is also a domestic corporation because the home office is abroad and also the branch is abroad. Third scenario, if the home office is in the Philippines and the branch is in abroad, the status of it is a resident foreign corporation. Last scenario, if the home office is abroad and its branch is in the Philippines, then its status is a resident foreign corporation.
So general concept, for a manufacturing business, the gross income recognized by the parent corporation is taxable to parent corporation, while gross income recognized by the subsidiary corporation is taxable to the subsidiary corporation. Hence, the gross income recognized by each corporation is taxable to each corporation because each corporation is a separated taxpayer. Hence, the status of taxation shall be place of sale without regard to the seller or supplier. So, for the example for INA Corporation has a subsidiary, ANAC Corporation, assuming production is conducted by INA Corporation and the distribution is conducted by ANAC Corporation. So, for INA, the sales is 4 million in the less cost of goods sold is 2,400,000. So the total of gross income is less 1,600,000. In ANAC, for the sales is 2 million and the less cost of goods sold is 1,200,000. So the gross income is less 800,000. So for the total of ina in anak for the sales 4 million and 2 million is equal to 6 million. For the total for ina in anak, the less cost of goods sold in 2,400,000 and 1,200,000 is equal to 3,600,000. And for the total for ina and anak and gross income 1,600,000 and 800,000 is equal to 2,400,000. Another example 4. What is the status of income for ina corporation? So for the scenario 1, we have the parent in the Philippines and a subsidiary for the Philippines. It belongs to within the Philippines and the amount is 1,600,000. So for the scenario 2, for the parent in abroad, the subsidiary for abroad also, it belongs to within the Philippines and the amount is 1,600,000. For the scenario 3, we have the parent in the Philippines and a subsidiary in abroad. So it belongs to within the Philippines and the amount is 1,600,000. For the scenario 4, we have the parent in abroad and subsidiary in the Philippines. So it belongs to without in the Philippines and the amount is 1,600,000. So we have another example for what is the status of income for the anak corporation. For the scenario 1, we have the parent in the Philippines and subsidiary in the Philippines. So it belongs to within the Philippines and the amount is 800,000. For the scenario 2, we have the parent in abroad and a subsidiary and abroad. So it belongs to without the Philippines and the amount is 800,000. For the scenario 3, we have the parent in the Philippines and a subsidiary and abroad. So it belongs to without the Philippines and the amount is 800,000. For the scenario 4, we have the parent and abroad and a subsidiary in the Philippines. So it belongs to within the Philippines and the amount is 800,000. For the scenario 5, for the last one, for the parent in abroad and subsidiary in the Philippines, we have within the Philippines and without in the Philippines. So it belongs to within the Philippines and the amount is 800,000.
Alright, here is the role of the members. We do have Ms. Carillo Leia, the PPT creator, Osol Jan Joseph, editor, and the presenters. And the other presenters, we do have Ms. Balento Pebe Murphy, Bungalon Roslyn, Mangubat Chari, and the researchers, Ms. Makindong Rochi, Mr. Donaire Rodolfo, Ms. Pamela Jade, Ms. Jama Charlotte, Ms. Lastimado Leia May, and lastly, Ms. Revilio Mary Grace. Now, this is the end of our presentation, and I would like to say thank you for watching, and I hope you learned something from us. We are Group 1 presenters. Thank you so much, and have a great day.